Indiana Life and Health Insurance Exam. 3 basic types of term life insurance. Level, increasing, and decreasing. Fixed period installments. Annuitant selects the time period for the benefits, and insurer determines how much each payment will be, based on the value of the account and future earnings projections, pays for a specified amount of time only, whether or not the annuitant is living. Modified life. Lower premium in first few policy years, 3 to 5 years, and higher level premium for remainder of insured's life. Automatic premium loans. Loan that prevents the unintentional lapse of a policy. Suitability. How well a recommended product will meet the applicant's needs and resources. Owner privileges of adjustable life. Increase/decrease the premium, change the premium paying period, increase/decrease the face amount of coverage, change the period of protection. Accumulation phase. Period after an annuity has been purchased but before distributions begin. 7 Pay test. Cumulative premiums paid during the first 7 years of the policy must not exceed the total amount of net level premiums that would be required to pay the policy up using guaranteed mortality costs and interest. New test required any time there is a material change to a policy. Increase in death benefit, essentially, determines if policy is overfunded or if it's a MEC. Single premium deferred annuities, SBDAs. Annuity is purchased with single payment, but benefit isn't paid until after 1 year or more has elapsed. Preferred risk. Results in lower premium. Spendthrift clause. Protects beneficiaries from the claims of their creditors, designed to protect life insurance policy proceeds that have not yet been paid to a named beneficiary from the claims of the creditors of the beneficiary of policy owner. Annuity. Contract that provides income for a specified period of years, or for life, protects person against outliving his or her money, vehicle for accumulation of money and the liquidation of an estate, deferred gross tax-free. Policy loan. Loan from cash value of life insurance policy, not income taxable to the policy owner. Individual cannot receive a deduction for interest paid on life insurance policy loan. Payer benefit rider. If the payer becomes disabled for at least 6 months or dies, insurer will waive the premiums until the minor reaches a certain age, such as 21, primarily used with juvenile policies, written on the life of a minor, also used when the owner and the insured are 2 different individuals. Joint life. Insures 2 or more lives, term or permanent, premium based on a joint average age, and the death benefit is paid upon the first death only. Survivorship life. Premium based on joint age, pays on the last death, lower premium than joint life, used to offset the liability of the estate tax upon the death of the last insured. Family income policy. Principal wage earner is the only family member insured. Reentry option. The insured, upon the end of a term policy with guaranteed renewable option, may qualify for a discounted premium rate with proof of insurability. Interest-sensitive whole life, current assumption life. Provides same benefits as traditional whole life policies with added benefit of current interest rates, which may allow for either greater cash value accumulation or a shorter premium paying period. Riders. Modify provisions that already exist, used to increase or decrease policy benefits and premiums. Continuous premium, straight life or ordinary life. Basic whole life policy will typically have the lowest annual premium. Straight life. Charge a level annual premium for the lifetime of the insured and provide a level, guaranteed death benefit. Installment refund, annuity. When annuitant dies, beneficiary will continue to receive guaranteed installments until the entire principal amount has been paid out. Variable life insurance and annuities. Cash values accumulate based upon a specific portfolio of stocks without guarantees of performance, keep pace with inflation, and are determined by the value of securities backing it. Warranty. A statement guaranteed to be true. Right to examine, free look. Allows policy owner a specified number of days from receipt to look over the policy and if dissatisfied for any reason, return it for a full refund of premium. Starts when policy owner receives policy. Cash refund, annuity. When annuitant dies, the annuitant's beneficiary receives a refund of the principal, or the original amount paid into the annuity minus benefit payments already made to the annuitant, guarantees the return of the amount to purchase the annuity, but it does not guarantee to pay any interest. Only difference between cash refund and installment refund is that cash refund is a lump sum payment. Provisions. Stipulate the rights and obligations of an insurance contract and are fairly universal from one policy to the next. Life with period certain. Annuity payments are guaranteed for the lifetime of the annuitant and for a specified period time for the beneficiary. Exclusion ratio, annuity. Total investment divided by total amount expected to be paid out over the life of the contract. Equity indexed whole life. Cash value is dependent upon the performance of the equity index, S&P 500. Although there is a guaranteed minimum interest rate, policy's face amount increases annually to keep pace with inflation. Concealment. Occurs when a person withholds a material fact that is crucial to making a decision. In insurance, this involves withholding information that would be crucial to underwriting decisions. Flexible premium deferred annuity, FPDAs. Annuity is purchased with multiple payments that can vary from year to year, e.g. portion of each paycheck, and the benefit payments begin sometime after 1 year from the date of purchase, e.g. payouts start at age 65. Level term. Death benefit doesn't change throughout the life of the policy. Law of large numbers. The larger a group becomes, the easier it is to predict losses, used to predict certain types of losses and set appropriate premiums. Representation. A statement true to the best of an applicant's knowledge. Increasing term. Death benefit increases each year over duration of the policy term, usually by specific amount or percentage of original amount, often used by insurance companies to fund certain riders that provide a refund of premiums of a gradual increase in total coverage, such as the cost of living or return of premium riders. Variable universal life insurance. Securities version of universal life insurance. Estate taxation. Death benefit of life insurance policy may be included in the insured's taxable estate at death and can be subject to the federal estate tax. Single premium immediate annuity, SBIAs. Purchased with a single lump sum payment and provides income payments that start within 1 year from the date of purchase, typically makes first payment as early as 1 month from purchase. Credit life. Written to ensure the life of the debtor and pay off the balance of a loan in the event of the death of the debtor, usually decreasing term insurance, individual policy or group plan. If group policy, creditor is owner of the master policy and each debtor receives a certificate of insurance. Creditor is owner and beneficiary of the policy and premiums usually paid by debtor, cannot pay out more than the balance of the debt. Fixed annuity. Guaranteed minimum rate of interest to be credited to the purchase payment, income, annuity, payments that do not vary from one payment to the next. The insurance company guarantees the specified dollar amount for each payment, and the length of the period of payments is determined by the settlement option chosen by the annuitant. Cost recovery rule. The amount of cash value that exceeds the sum of the total premiums will be taxed as ordinary income when cash withdrawn or policy surrendered for cash value. Equity indexed annuities. Fixed annuities that invest on a relatively aggressive basis have guaranteed minimum interest rate often tied to familiar index such as the S&P 500. Generally, insurance companies reserve the initial returns for themselves but pay the excess to the annuitant. Premium mode. Manner or frequency that the policy owner pays the policy premium. If other than annual, there will be an additional charge to offset the loss of earnings since the company does not have the entire premium at once, and there are additional administrative costs. Decreasing term. Death benefit decreases each year over duration of the policy term, typically used when the amount of needed protection is time sensitive, or decreases over time. Modified endowment contract, MEC. Any life insurance policy that fails a 7-pay test loses the standard tax benefits of a life or insurance contract. Death benefit received by the beneficiary is tax-free. Cash value, tax-deferred accumulations. Any distributions are taxable, including withdrawals and policy loans. Distributions are taxed on LIFO basis, known as interest first rule. Distributions before age 59.5 are subject to a 10% penalty. Single premium whole life, SPWL. Provides level death benefit to the insured's age 100 for a one-time, lump sum payment. Policy completely paid up after one premium and generates immediate cash. Net premium. Premiums without expense loading. Life with guaranteed minimum, annuity. If annuitant dies before the principal amount has been paid out, remainder of principal amount will be refunded to the beneficiary, also called refund life, guarantees that the entire principal amount will be paid out. Family protection policy. Combines whole life with term insurance to cover family members in a single policy. Whole life on breadwinner, permanent life insurance, and convertible term insurance, term riders, on the other family members. Bailout provision, annuity. Allows the contract holder, in the event that interest rates drop a specified amount within a specified time frame, to surrender the contract without charge. Expense loading. Combined with premiums to spread the operating costs of a business to all insureds. Absolute assignment. Transferring all rights of ownership to another person or entity. New policy owner doesn't need to have insurable interest in the insured. Settlement options. Interest portion of the payments received is taxable as income. Immediate annuity is purchased with the face amount at death or with the cash value at surrender. Fixed amount installments. Annuitant selects how much each payment will be, and the insurer determines how long the benefits will be paid by analyzing the value of the account and future earnings, pays a specific amount until funds are exhausted, whether or not the annuitant is living. Pure life, annuity. Known as life-only or straight life, payment ceases at annuitant's death, provides highest monthly benefits for an individual annuitant, no guarantee that all proceeds will be fully paid out. Participating insurance policy. May pay dividends to the policy owner. Entire contract. Provision that stipulates that the policy and a copy of the application, along with any riders or amendments, constitute the entire contract. Common disaster clause. Provided under the Uniform Simultaneous Death Law, assumed that the primary beneficiary died first in a common disasters. Most insurers specify a certain period of time, usually 14 to 30 days, in which death must occur for this provision to apply. As long as the beneficiary dies within the specified period of time following the death of the insured, it will still be interpreted that the beneficiary died first. Accidental death rider pays some multiple of the face amount if the death is the result of an accident as defined in the policy. Death must usually occur within 90 days of such an accident. Variable annuity serves as a hedge against inflation. Annuitant may receive different rates of return on the funds that are paid into the annuity. Three main characteristics: underlying investment, separate account, interest rate, and license requirements. Options: offer insurers and insureds ways to invest or distribute a sum of money available in a life policy. Dividends, policy. Non-taxed returns of unused premiums. Surrender charges. Purpose is to help compensate the company for loss of the investment value due to an early surrender of a deferred annuity levied against cash value, and generally a percentage that reduces over time. At surrender, owner gets premium plus interest, the value of the annuity, minus the surrender charge, the value of the annuity at surrender. Waiver of surrender charges if annuitant is confined to a long-term care facility for at least 30 days. Accumulation period. The pay-in period, the period of time over which the owner makes payments, premiums, into an annuity, period during which payments earn interest on a tax-deferred basis. Adjustable life. Insured determines how much coverage is needed and the affordable amount of premium. As insured's needs change, policy owner may make adjustments such as increase or decrease the premium or the premium paying period, increase or decrease the face amount, requires proof of insurability for increasing the death benefit or changing to a lower premium type policy, or change the period of protection. Policy owner also has option of converting from term to whole life or vice versa. Annuity period. Known as annuitization period, liquidation period, or payout period, time during which the sum that has been accumulated during the accumulation period is converted into a stream of income payments to the annuitant, may last for the lifetime of the annuitant or for a specified period, which could be longer or shorter. Limited payment. Premiums for coverage paid up before age 100, higher premium and cash value builds up faster. 20 pay life. Life paid up at 65, LP 65. Fixed life insurance and annuities. Contracts that offer guaranteed minimum of fixed benefits that are stated in the contract. Collateral assignment. Transfer of partial rights to another person, usually done to secure a loan or some other transaction. Partial and temporary assignment of some of the policy rights, once debt/loan repaid, assigned rights returned to the policy owner. Variable whole life insurance. Level, fixed premium, investment-based product, guaranteed minimum death benefit. Cash value is not guaranteed and fluctuates with the performance of the portfolio in which the premiums have been invested by the insurer. Policy owner bears investment risk in variable contracts. Annually renewable term, ART. Premium increases annually according to attained age. Policy may be guaranteed to be renewable each without proof of insurability. General account. Comprised mostly of conservative investments like bonds, these investments are secure enough to allow the insurance company to guarantee a specified rate of interest, as well as assure the future income payments that the annuity will provide. Fixed annuity premiums are deposited into this. Standard risk. Results in standard premium. Insuring clause, insuring agreement. Sets forth the basic agreement between the insurer and the insured, states the insurer's promise to pay the death benefit upon the insured's death, usually located on the policy face page, and also defines who the parties to the contract are, the premium to be paid, how long coverage is in force, and the amount of the death benefit. Material misrepresentation. Misstatement to a question asked in the application process. Death benefit claim will likely be denied. Deferred annuity. Purchased with single lump sum, single premium deferred annuities, or as purchase thought periodic payments. Flexible premium deferred annuities grow tax-free. Income payments begin sometime after 1 year from purchase. Used to accumulate funds for retirement. Owner receives current interest rate or guaranteed interest rate, whichever is higher. If surrendered prior to age 59 and a half, income tax must be paid on gain, and 10% penalty will be imposed on the taxable portion. Annuity income amount based on amount of premium paid or cash value accumulated, frequency of payment, interest rate, annuitant's age and gender. Graded premium whole life. Premiums start low, gradually increase each year, for about 5 to 10 years, and remain level thereafter. Buy-sell agreement. Business continuation agreement that determines what will be done with the business in the event that an owner dies or becomes disabled. Juvenile life. Any life insurance written on the life of a minor, jumping juvenile, is a common type where the face amount increases at a predetermined age, often age 21. Premium remains level throughout. Level benefit payment amount. Amount of each payment received from the annuity during the annuity period. Application of state law. Provision that states that no matter what the home state of the insurance company or the applicant is, the law of the state in which the policy is sold would be considered the law under which the policy will be enforced. Universal life, flexible premium adjustable life. Policy owner has the flexibility to increase the amount of premium paid into the policy and to later decrease it again. Interest-sensitive policy with a guaranteed contract interest rate, usually 3 to 6%, and opportunity to get the current interest rate. 2 components: insurance, always annually renewable term insurance, and cash account. Option A, level death benefit, and Option B, increasing death benefit. Convertible term. Provides the policy owner with the right to convert the policy to a permanent insurance policy without evidence of insurability. Premium will be based on the insured's attained age at the time of conversion. Substandard risk. Results in higher premium.